So let's check out some assumptions that I have already incorporated within the feasibility application so that you know exactly what is happening or what the application is actually doing. So they are right here. So we'll just zoom that in a little bit more so you can get a clearer picture of where we are at. So we are at right here. And we've got certain assumptions, council contributions, what they are, what it means, and so on. So let's look into each one of them. So let's say we are here, for example. So the first thing is that if GST and VAT is applicable to you, it goes without saying that all costs that you put in will include that GST component in them. If it doesn't apply to you, don't worry about it. Margin scheme again is only applicable in Australia. When selected, it calculates GST on the capital improved value by deducting the land value from gross sales. So how that happens, what it happens, isn't in the scope of this video. So I'm just letting you know how this calculation would take place. So if you ask your accountant how you calculate GST under margin scheme, they will tell you, but trust me, it has already been included and incorporated in the feasibility. What I refer to as stamp duty, and in a lot of countries, that's what people refer them to. It's basically an ad valorem tax imposed at the time of the transaction and is calculated on the value of the land. So let's say you buy the block of land for $1 million. In Australia, 5.5% of that amount, let's say 55,000 in Victoria, for example, goes to the state revenue office. So that is, I think in US it is known as property tax. It's a tax levied on top of the value of the property that the government takes at the time of sale. Council contributions, what are they? So council contributions are basically development and infrastructure contributions in form of fees, taxes, or levies paid to local council, municipalities, or equivalent authorities, or your local government authority, LGA, in other words. Next, we have certain general assumptions. So let's look at these. So agents commission, GST, VAT liability, and construction finance costs are all paid out from settlement proceeds when the project is complete. So basically, all these things can be structured in a detailed feasibility. Let's say, for example, lead developer, the main detailed feasibility application that we have. All these have different way of calculating, and they can be calculated at different times as well. However, for the smart feasibility calculator and to keep things super simple, we have actually used them in at the end. We basically calculate them towards the end of the project when the project is about to finish. Developers' equity contribution are calculated based on the amount of debt available. A negative total would mean that there are more funds available to borrow. Say, for example, if your total developer's equity contribution turned out to be negative, that basically means that more than likely you are trying to calculate a debt based on the total sale value, and you have a very high loan to value ratio. So in that scenario, that basically means that, but trust me, anytime you do a development, you will never be able to do that. You will never be able to add, there will never be a time where your contribution would be negative. That basically means that the bank's giving you money to do the development. That'll never happen. But if you put wrong numbers in there and you see a negative figure, it's not because of the calculation. It is because it is telling you that somewhere or the other you selected gross realization value or total sales, GRV, as your to determine the amount of money that you can borrow, and you have a very high loan to value ratio, like 80% or 90% or so on. All costs are funded by the developer except for the borrowings for land and construction. So you need to keep these things in mind when you are doing your numbers. So these are some certain abbreviations that I've used in this model. So LAC stands for land acquisition cost, land value, or the land purchase price. It's exactly the same. So if you see LAC, that basically means land acquisition cost. GRV, or gross realization value, or gross development value, or total sales value. That means that the total sale value, including the sum of all the units that you are developing, let's say 10 townhouses, the end value that you will sell them for in the market is basically GRV. Then you've got total development costs, total cost of the development, straightforward. You've got LVR or LTV, also known as a loan to value ratio. You've got return on equity, or COC, or cash on cash return. You've got residual value of land, which is calculated based on the risk margin or the target development margin that you set in the feasibility. NSA stands for net sellable area, and NLA stands for net lettable area, which is in case of you have a mixed use development, or you're trying to run numbers on a commercial property and you want to figure out the net lettable area, that's where this NLA is used. GBA is gross built area, which basically means total constructed area including any basement. So these are certain abbreviations that we use. Then we've got finance assumptions. The first one is the land loan acquisition is assumed to be refinanced with construction loan before construction starts, and you can choose a different interest rate for land interest. So anytime you do a development, again, this is not part of the scope. If you're interested in finding this out, I think you should invest in the in-depth feasibility training that is optional, that explains all these things, how they impact, when they come in, how are they calculated, all those things. So then you've got, next one is land acquisition loan, which is interest is assumed to be capitalized during construction phase. Next one is interest calculation on construction loan draws is based on a drawdown rate. What is a drawdown rate? It's the intensity or the speed at which you draw down your construction loan that the banks approve to you. So bank's not going to give you, let's say a bank gave you 1.5 million for construction. That was a total development cost, and the bank said, okay, we'll fund 1.2 of it. You're not going to use 1.2 million on day one of your construction, or after the first month of construction. It will be done at a periodic rate. So that is the drawdown rate, and we do the calculation based on that intensity. Construction interest is calculated assuming the full loan amount will be utilized, and also interest payment on land loan before construction starts are paid by the developer. So we keep in mind when you go into construction and you have another loan at a different interest rate just for holding the land, those interest costs are actually taken into account as well. So if GST and VAT is applicable to you, which if you are from US or Canada, it will not apply to you. But if you are from Australia and New Zealand, you should pay some attention here. Goods and services tax is a value-added tax levied on most goods and services sold for domestic consumption, and the GST is paid by consumers, but it is remitted to the government by the businesses selling the goods and services. And to disable GST tax, you just select NA, which is not applicable, which is what I showed in the previous video. You basically select that and set the tax rate to 0. Even if you didn't set it to 0, it'll still work, but it is a good practice to just put it on 0. We've got GST and VAT are treated the same way based on the percentage allocated, and total GST and VAT liability is calculated as GST on sales less GST divided by VAT, less GST and or VAT on expenses. And all costs are including GST and VAT if they are applicable. This is something I'm repeating from this first set of assumptions. So these are the assumptions that we have. You can read them in your own time. You can find out what stamp duty is. If you click on a link, it takes you to a Wikipedia page that explains what it is. And yeah, we've got all these assumptions, and the next video we'll dive into going through every aspect of this feasibility in the next video. We'll see you soon.